Hi guys, I'm Brady McDonald, and the highest and best use for my business is sexy self-storage in the US.
Thanks for tuning into the highest and best use real estate podcast, where we talk about techniques to optimize your land, structure, skill sets, and time, as well as the highest and best use principles to make your business more profitable, productive, and efficient. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. And today, oh my gosh, I'm so excited about this. Brady McDonald's on the show. Brady, what's up? Thank you so much for coming.
Hey buddy, yeah, thanks a lot for having me, Ryan. I'm excited to talk to you guys.
Oh man, this is good. So Brady, you've done so much, man. God, how do I even start this? Previously an Ontario duplex, triplex investor, moved down to Florida to flip, and now you're doing development of storage units with Brian Baumler. That's incredible.
Yeah, thanks. It was a good transition. We do obviously. We've had a lot of our histories. Your and mine are very similar, right? And started probably around the same time back in Ontario, and we just got to a point where we wanted to kind of mix in that lifestyle and live it. So that's where we headed down south in the land of opportunity right now. So you got palm trees and deals.
Oh man, the best palm trees. I love it. In terms of maybe just introducing the show and kind of where we're going to take it today, I really want to dive into self-storage. I want to talk about the before, the during, and the after. So the before would be like, okay, when you're looking at a storage facility, how do you evaluate what might be a potentially good deal? What do you do first? What types of studies do you need? What about zoning? Let's talk about the before side before you buy. The during would be like the construction. So when you're building it, how do you build it? What does that cost? Why do you build it the way that you do? And then on the back end, the after, do you keep it or do you sell? How do you exit from this? So that's kind of
all right.
That's where I want to take the show. So introduce yourself, give us the 30-second high level of Brady, and then we'll go into it.
Okay, cool. Yeah, so Brady McDonald, we've got a real estate company in Canada. It's called BK Real Estate Investing. We're in Canada. We're property managers. We have a construction company, development company. We do sewer, water, duplexes, triplexes, 10 units. And yeah, like we've just explained, we came down to the US and started transacting down here, and now focusing on self-storage developments in the southern US. So we've got about 2 sites that we've actually closed on that we're about to start construction on, and we've got 3 sites under contract outside of that we're actually working on due diligence. So we'll be able to kind of meet, have a conversation along the way of what that, exactly what you were looking to get out of this, right? So
I love it. So you said 2 sites ready and 3 sites under contract?
Yeah, 3 other ones under contract. Yeah.
Oh my God. How many units would this be in total?
Most of the storage is actually calculated on net rentable square feet. Okay. So most of these, the first 2 sites are very close to 1,000 units. So there's one's 930 and the other one's 980 some odd units. That's 113,000 or 109,000 net rentable square feet and 130,000 net rentable square feet. So, yeah, so that's kind of how storage is measured. I mean, a lot of people talk about units, but most of it's based on square feet, because the square feet is what is actually pays you. Is that's what you're trying to get.
Yeah, sure. So if somebody's renting a 10 by 10 storage unit, they're paying so much per square foot. If you go to a 10 by 12, they'll pay a little bit incrementally more based on the size of it.
Yeah, they'll pay more for the unit, but as the units get larger, the cost per foot goes down.
Yeah.
Right. So your highest our ROI is on the smaller units for sure.
Mm-hmm. That's the same. I guess that's the same with like a bachelor apartment, a 1-bedroom apartment. Progressively, the price per square foot goes down as it goes to a 3-bed.
Yep, you bet.
Right on. So in terms of the before, how do we evaluate a good opportunity? What does a good opportunity look like, and where do you start?
Yeah, it's a good question. So the first couple deals we did, so I hired a coach, right? So this is the first thing that I would just like to say is that, when you get into anything, the first time, I think residential, single family, duplexes, triplexes is a little bit different. I think you can get away with, not requiring a coach on those types of properties, but these projects are $30 million deals. Right. So it would have been really crazy for me to jump in and think that Brady's the expert when he wasn't. So I hired a coach, that mitigates a lot of the risk. And obviously I can elevate, what's the word? The word's gone. Anyway, I can leverage his experience and his contacts. So the first 2 deals we took on as an assignment. So I actually, he assigned them to me. He took a fee obviously for that. So they were shovel ready. And then what that did was it got us to the point where we could raise the capital, okay, syndicate the structure of the deal, syndicate, raise the capital, and actually get to construction a lot faster than if we did the due diligence associated to finding the raw land, right? Getting, doing all the studies, making sure that the site is feasible and in a good location for self-storage. Um, so, but yeah, so obviously on these other the deal 3 to 5, the other ones I said that I had under contract, those sites are ours where we found the raw land, and I can talk to you about that. So, we've actually got a team, an acquisitions team that's all they do. So there's about 5 of us that look at these sites, one main person, and that person's looked at probably 600 land sites in the US in all the southern states, to kind of like moseying up into like some of the mid states where snow is not such an issue. And so he's looking at it from up, like, first of all, we're looking for sites that are zoned appropriately, or that they we don't really want to get into rezoning because of the time, and then with time becomes risk. So there's so much land here in the US. For example, the sites that we're buying in Texas, our cost as a piece of dirt that doesn't have entitlements, where zoning really isn't permitted yet. It is an approved use, but it's not permitted and the studies haven't been done. We're buying those sites or getting them under contract for like 700,000, 700 to $1 million. Okay. And then, obviously we do all this extra due diligence and make sure that use is permitted and get approvals and get site plans and do feasibility studies, et cetera, et cetera. Then the land's worth about 1.5 million. You compare that to Canada, the same site in Barrie is worth $7.5 million as a piece of dirt that needs to be rezoned. So
that's incredible. That's a huge spread.
Well, that's your profit margin, right? That's the profit margin. And our guy will look at the site and be like, okay, is zoning permitted in this area, right? Okay, zoning's permitted. Okay, then what he'll do is he'll run some metrics on a program called Radius Plus. And on Radius Plus, he's looking at the population, the amount of people the amount of people in that area. What is their median household income? Okay, and we're going to look at these metrics in a 3 mile radius, 3 to 5 mile radius. Okay. And so there's bare minimums as to what we want to see. Okay. So we want to see at least 50,000 people in a 3 mile radius. And we want to have a certain income based on that amount of population. And then,
Brady, are you talking 3 mile radius of the build site or of the city center?
No, around the build site.
Okay.
So yeah, that is basically your competition locations. So we're also looking at how much storage is within that area, right? So this Radius Plus will do a calculation and look at all the other neighboring self-storage facilities in the area, and it'll say, okay, well, in that area, there's 500,000 square feet of storage already, and based on the population, there is 700,000 square feet of demand, or it may say that there's only 300,000 square feet of demand. So right there, you can do quick math, and we stick it into a spreadsheet, and it'll tell you, is there a net demand? Like, are we undersupplied or oversupplied? If we're oversupplied, we're likely going to kill the deal, right? If we're especially if it's significantly oversupplied. If it's oversupplied a little bit, we may look at it a little differently and say, okay, well, what are they factoring into this? Because sometimes, obviously, Radius Plus is a program, so it may take up some industrial that really isn't self-storage, but it may be storage for contractors, like where you're driving in trucks and stuff inside.
Yeah.
It may also, if we're looking at building a Class A facility, that's what we build. It's brand new state-of-the-art facilities. It may be taking in a pile of Class C storage. And when you look at it, really Class C is, it has a factor, but it's not, the difference is so dramatic that, we could take a lot of the supply from a Class C just by being in a better location, well lit, right? Obviously it's cleaner, it's newer, people can access it online. And we look at the competitors and say, okay, well, if all those are full, the occupancy is high, right? Then, based on all these factors, we're going to start making a decision if we want to maybe put it under a letter of intent, and if we want to do a feasibility study on that.
What's the difference between Class A and Class C?
Yeah, so class A is going to be built, newer than 2000. Okay, and class C is going to be older, so it may be 60s, 70s, into the 80s. Class C is going to have, often it's going to be in, like, down a dirt road in a rural location, likely doesn't have asphalt driveways. Um, it's kind of in the middle of nowhere. That may have poor lighting. It's just dated. Where
Mhm.
your class A, you're going to have, it's going to be in a well lit, like, high traffic location. Asphalt. It's going to have security cameras. It's going to have power gates. It's going to have, like, all the modern technology to it.
Wow. Okay. So I mean,
Yeah.
the price difference for dirt for a class C versus a class A, I would imagine would be substantially more for your class A, or are prices relatively comparable?
Yeah, well, I mean, the Class A facility that we're building, the dirt is the least valued, thing out there, because the asset
Wow.
isn't built on it, right?
Yeah.
And we're
Yeah.
talking about highest and best use, right? There's no better way than development to increase the use of a piece of dirt, right? But, one, obviously getting it entitled adds a lot of value,
Mhm.
right? Meaning that zoning is, storage is permitted, and that it's feasible, meaning that there's a business plan that, a bank would support this. That adds a lot of value, obviously, as well. Where
Yeah.
Class C it's already a Class C. It's been a Class C forever. It's been there forever. It's been built for 40 years, right?
Yeah.
So it's kind of hard to compare the two when you're talking about development. But
Yeah.
when you're looking at these other classes of facilities, there's lots of opportunity just from an investor standpoint, and to consider the highest and best use of these facilities. I know a couple companies that I spoke to lately where they purchased about $1 million of the Class B and C assets
Yep.
in the past 2 to 3 years. And so their intention on that is purely just increase the net operating income. So, how can they do that? They could put new lights up there. They could asphalt it. They could paint it. They could put security cameras. Just put a new signage. Or it could be just purely by managing it properly, because a lot of these types of facilities are ran by mom and pops, right? That
Mm,
have owned it for 30 or 40 years, which
right.
means, they probably didn't increase the rents every 9 months, which is what most, properly managed facilities should be increased at. So
Interesting.
they'll,
Okay. So then
yeah,
when you go into a deal like this, in terms of, you mentioned you bought this one on assignment contract, and that helped bypass some of the logistics on the front end. Can you talk a little bit about why that was beneficial to you, especially for your first go?
yeah, for sure. So we started this self storage deal in March. Okay, so, and we closed. Yeah, so in March, and I closed on that first. Actually, it was probably a month before that. Like, within a month of, like, talking self storage with my coach, I closed on a piece of dirt, or a piece of land that was shovel ready, meaning that we know storage could be built there.
Mhm.
And we raised the capital within a month, and we closed on it. That happened that fast. Where these other three sites that I've got under contract, we started building that team March, April, and May. Okay. And so I had the team in place May and June, and it's been taken till now. We're still probably 2 months away from closing on any sites. Okay. So my goal here was to transact on something fast, right?
Yep.
Because the sooner you can get proof of concept, and that you can prove to your investors and the people that you need, that you've done it, I mean, everything just gets easier. So I'm just like, okay, well, let's fast track this success. How do I do that? Well, I can take a shovel ready site.
What do you say? Turning decades into days, something like
Decades into days. That's
that.
right.
I love
Yeah.
that. I saw that on your social media. I'm going to say like a year ago.
Yeah.
For those of you who don't know, I've known Brady for a long time now, and like it just, I thought that statement was so powerful. I think, like I said, I think I saw it about a year ago. I was like, decades into days. My gosh, so many people just take so long to actually get the ball rolling, and here you are, literally turning decades of learning into days of, hey, get a coach. He assigned you a piece of dirt, and now you're building on that dirt and proving your concept, as you say. Like, that's incredible.
Yeah, exactly. Yeah, like, I mean, and so I could have, been to the point where I'm at now, where we're about to put a shovel in the ground in a year from now, right? I didn't know, but at least I knew the outcome. I knew how fast we could do it. So, yeah, turning decades into days. And I think you're right by, if you want to go fast, you can either going fast without a coach is relatively risky, because you don't know all the outcomes,
Mhm.
right? But if you want to go fast and go big, then hiring a coach really helps mitigate a lot of those risks, because they see your blind spots where you don't.
Love it. What is it that you know now that maybe you didn't know before you got into it?
Um, that the capital raising is hard. I mean, so that is the biggest thing that I'm finding right now. Obviously, the market is extremely difficult. Based, interest rates going up, the uncertainty is increasing. I mean, it's a horrible time to try to raise capital, and we're not experts at raising capital. We were really good at becoming finding joint venture partners and raising capital from people that, could put their name on title and do all that kind of stuff. This is totally different. Right. So that's one thing. And so, of course, when we did everything in Canada, we did everything ourselves. Right. And so when I got into this, of course, we didn't do the first couple of deals. We didn't do the due diligence up front to get it shovel ready, which is good. The next deal, we did raise all the capital ourselves. The deal that we've already closed on, we're still raising a bit of capital. We started going down this road like, okay, we raised all the capital for the first one. This is going to be no harder, and it's a lot harder. So I've been what I've been saying to my CFO and my team is that we need to go back to the who, not how. Right? It's more important that it gets done and that it gets done properly than trying to figure out how to do it. Right? Because, sure, I could become a capital raising expert and we could hire a team to do that, but that takes way too long and we don't have time for that crap.
Right. You've read the book, Dan Sullivan, obviously.
I actually haven't, but
what?
I understand. I understand the concept.
Dude, Dan Sullivan wrote this great book called Who Not How. I figured that was the
I know. Yeah, I know. I need to read it. Everybody says that, but yeah. So that's kind of where we're at. That's one of the things. I think part of that is due to the market. But I think it's a good reminder. I mean, I'm okay if it's hard right now. I know I'm willing to put in the work, and it's only going to get easier. So it's better that we get these reminders now than later.
Love it. Okay, so in terms of your structure, so we talked a little bit about how this is being viewed on the way into a deal. In terms of capital raising now, since we're here, is this a GPLP structure? How does this work? Is this a REIT?
Yeah. GPLP structure on the first few deals, and so that's exactly how we've set it up. So. Initially, and again, we talk about how things change. Initially the market was able to offer we only had to raise 20% equity from our limited partners.
Yep.
Right. So, and expecting that we could get an 80% loan to cost construction mortgage. Now those days are gone. So we've switched now and increased our capital raising efforts. Even on the first deal, we're going to have to raise another 5 to 10%. That capital is not a capital call to the investors. We've got it set up so it's just like it's literally coming out of my share, our GP shares. So that's one thing we're seeing. As the market changes and as the banks mitigate a lot of their risk, they're increasing the capital requirements. So that's one thing that we're doing. The underwriting is different for future deals, and we're actually having to go back and revise some of the projections on the past deals. Yep. But yeah, good thing, when we do these underwriting, I've got lots of experience doing underwritings. Like when we did obviously all of our smaller deals in Canada, I ran a pro forma, I did, the projections myself. Now Tyler, and this is, talk about how these big deals get done in this type of structure, within a GP here in the United States, or within a GP anywhere, whether you're going to do a GPLP structure in Canada or US, you really need to put the people on that team that make you strong, because independently, one person on a deal this size doesn't look great, in a GP, because, it's really hard to be great at everything when on a deal this big. Right. So, so I've got my coaches, Brian and Joe, they're on there. And again, so on one of your first couple deals, you're going to need to put people on there to build you credibility.
Yeah.
Right. So they're on there for credibility and experience, and obviously to hand hold. But Tyler is also, so Tyler is a cousin of mine. Actually, he's an American though. So he's actually from Texas. He's a mortgage broker. He's only like 30 years old, the little bugger, but he's got he's got 40 employees that work for him. He's a hustler, entrepreneur. He's done these types of syndications before. He's done land development before. So, and he's also a chartered accountant. Like he's the guy that is everything. So
he's got it all, total package.
Yeah. So again, from an underwriting perspective and from a due diligence perspective, he's really strong. He makes us look really strong again, right?
Mhm.
So there's nobody that can really, out like underwrite him or like really throw him a question where they don't really know the answer. So yeah, so he makes us strong, and then of course there's Brian Baumler. He's partners with us on these self storage deals as well.
Mhm.
And Brian is Brian is extremely successful. Obviously, everybody sees him on TV. But what you see is what you get. But he has over 150 employees.
Wow.
He's extremely great businessman and developer in Canada, and he also had the goal to expand into the U.S. and actually, obviously, in the Bahamas too, right? So,
Mhm.
yeah, so he had an appetite for that, and we partnered together, to help get these deals done as well.
Awesome.
But
How does it, when
yeah,
you're doing a GPLP, how does it differ as opposed to maybe just opening up a corporation and selling shares? What is the difference there?
yeah, that's a really good question. To be honest, I'm not an expert at like all the varying types of um, structures. A
Mhm.
GPLP is common, in these types of syndications, though.
Yeah.
And the one thing about the way that we structured this particular, all of these projects are under a GPLP structure that is used, but we're using limited partnerships. I know, as a Canadian, to invest in a corporation in the U.S., then you're going to set yourself up for different tax liabilities that aren't going to be favorable. So we've set this up in a way that investors in Canada can invest directly into the limited partnership who actually holds the ownership of the project,
Yep.
and without worry of double taxation and these other implications that I'm talking about. So, I think that's the biggest thing, going into the States and dealing with cross border is really understanding that structure in which you're partnering or investing in, and making sure that it's going to work on both sides of the border and not, force you into paying more tax than you want.
That's right. How do you hedge the currency conversion?
You know what? It's not as bad as what everybody thinks. So I did this the other day just because I'm like, okay, well, what is the actual cost? Okay, so for example, if don't quote me on any of this, but well, no, you can pretty much quote me on this. I ran because the exchange was like at 1.4 Canadian dollars for every American, right? I think it's gone down a little bit since
Right.
this was 2 weeks ago. So
Mhm.
I'm like, okay, well, what's because some of these investors, I'm like, well, no, it's just with the rates. I don't know, like, because there certainly could be the cost. There could be a cost of exchange if the rates were extreme. I mean, if for example you invested and it was $1.40 and it went to par, I mean that's going to
Yeah.
probably impact you a little bit more. But
Mhm.
for example, $1.40 to $1.30 over a 4-year project, it changed the yearly return on investment by 1%. Okay, so our projected returns on the most recent deal is 26% yearly return on investment for the investor.
Mhm.
And these are for accredited investors. I'll just put that disclaimer out there. So
Yeah.
credit investors only. But yeah, so that 10% difference in the cost of money only equated to a 1% difference, lower return on investment per year.
Wow. Man, on
Yeah.
26%, that's pretty inconsequential.
Yeah, well, exactly. Yeah. I mean, even realistically, if it was 17% and it is only, the return ended up being 16%, right? I
Yep.
mean, it's what 1 point difference, it's not gonna change your decision to invest,
Yeah,
I wouldn't think.
for sure. How do you differentiate between raising money from a US citizen versus raising money from a Canadian? Or is that even a discussion point?
So yeah, so we've got these projects set up so you can raise capital from both.
Yep.
But like, so normally if this was done in the US, the GPLP structure would be primarily made up out of LLCs.
Mhm.
And because it's Canadian, we've set them up in an LP structure, and it has everything to do with the flow through back to Canada, and that it prevents double taxation for the Canadian investors. So if and that's one of the ways. There's another way where you would set up a limited partnership in Canada in which the Canadians would invest directly in, and then that limited partnership is the LP investor into the GPLP structure in the US.
Yeah.
Yes, there's lots of ways to skin the cat, but this is the way that we decided to do it, was that the investors go directly into the USLP because we didn't know how many Canadian investors there were going to be. And for example, it could cost you $10,000 to $15,000 to set up that USLP and get all the Canadian docs set up for. And if there's only one investor, it's just way too costly. We can do a lot of tax returns for that amount of money.
That's right. What does it actually cost to set up this whole structure end to end?
Yeah. So the very first deal, it was 20,000 US and 20,000 Canadian.
Mm-hmm.
And then the second deal, we actually did it for about 20,000 Canadian, because the Canadians, that firm that we work with actually has expertise on both sides, and the structure was very similar. So we didn't have to really, we weren't inventing the wheel.
Yeah.
So yeah, 20,000 Canadian, which is pretty reasonable.
That does sound reasonable. I thought it was way more. I thought there was way more paperwork, way more logistics, but that's not so bad.
Yeah, it's not horrible. Yeah.
At what point do you say, okay, the size of the project justifies a GPLP?
What?
I think you're not doing this for a duplex.
No. I would think I think it depends. I'm not a lawyer, so you should totally, go back to your lawyer and figure this out, or reach out to me and I'll tell you mine. But I think it, in my head, if there was me and two investors who I know, or 3 or 4 investors that I know, then you could probably just set up a US entity and do the share structure, which kind of like what you were talking about before. And you'd probably be, you would set up a USLP or something like that, where, the 5 people went in there, because they're probably investing enough, or there's not going to be 20 investors type deal. I think you could probably set that up like that. But, when they're right now, these deals, they could be 40 investors. Right. And, and the other thing too is, then you need a partnership agreement. So, to negotiate a partnership agreement with 5 people is a lot different than negotiating a partnership agreement with 35 people or 40. Right. I think that
you're renting an event center.
Yeah, exactly. Could you imagine? Anyway, so I think that's one of the factors that would kind of decide. But, we're doing a syndication here for new construction places in Cape Coral. It's been slow running just because my time requirements and the hurricane and family stuff. But the idea there is that we find 10 new construction sites in Cape Coral, because the cool thing of this city is that 40% of the city is still undeveloped. And they severed it all back in the 60s and 70s. So you can come in and buy a lot and develop on it, build on it.
You're talking residential.
Residential, yeah. So we're going to do 10 of those new construction houses, single family homes, and do 10 of them. We syndicated that. We put 10 investors in there. And to me, there's enough meat on the bones that a $20,000, setup fee still seems very reasonable.
Yeah. Okay. So we've talked financing, we talked finding property, we've talked software, which is a really cool angle. How you plug all the digits into the software and it spits out an answer. What else have we maybe not talked about on the way into a deal before you put the shovel in the ground?
Yeah. So what have we talked about? So I mean, the big thing about this is really, figuring out whether it's feasible, right? And making sure that you can get your actual entitlements. So entitlements mean that you're permitted, that there's sewer and water connections. That's something that we've ran into that becomes an issue. Where is the sewer and water? Do you have access? Do you have enough access points into the site? What easements are on the site? Because there's some, there's been sites where we get into where the easements just jam you up and you can't build the amount of square feet that you want. What other things? Environmental, right? Pond size. So there's detention is a big thing, obviously. Water retention, because these are very large sites. So you need to either retain the water and slow it down, or detain it. So detention, retention ponds, those pond sizes are a big factor, because again, they take up square feet. What else? We talked about environmental, obviously. Feasibility studies is a big thing. Is we hire a third party feasibility company where they're the ones that determine realistically, is storage here a great plan?
Sure.
Right.
Sure.
And we'll pay probably $4,000 on a kind of a feasibility, desktop feasibility. And then we'll, if that comes back good, we'll throw it to some other partners to analyze it. If we like it, we'll go, okay, let's spend more money on a full feasibility study, which is the one that we would end up giving, justifying our underwriting on. It would also be the one that goes to the bank. Right. So yeah, feasibility studies, environmental, architectural. There's a ton of documents. I probably spend about $80,000 on a site, and still there's a chance that I kill the deal. Like, yeah. So we probably spent $50,000 on one on El Paso when we ran out of diligence time, and they basically held a gun to our head and said, like, we're not giving you any more due diligence time, yes or no. And I'm like, well, I'm not closing. I'm not going to sacrifice $20,000 more of our EMD or down payment, or our deposit money, for a site that I don't know I can get water to, right?
Yeah.
And so there's that opportunity. But again, that's the risk the developer plays, right? I think, when you think about whoever the person that's going to make the most amount of money is going to be the person that does the most amount of work. So when you can find a raw piece of land, whether it's residential or for storage, and you're the first one to touch it, and then you sever it or rezone it or do whatever to increase the use of the land, you're going to make the most amount of money, right? And so but there's also the risk that there's a lot of ways for this to go bad and for you to spend money and not do the deal, right?
Yeah, that's interesting. You say that's where the most amount of money is made, in the land.
I think so.
Yeah.
I mean, if you could, I know a couple of guys that all they do, and I think this is a good opportunity in the South, because there is so much land down here, and there's a lot of agricultural land still around fairly densely populated areas where you can grab that agricultural land. It's the easiest to rezone. Spend the time rezoning it. You could likely negotiate this so it happens under contract, and you get it rezoned to commercial or residential or whatever you think is the highest and best use, right? Or most profit, and then just sell it to a developer. I think, there's people that make millions and millions of dollars on that, and they may put 50, 60 or 100 grand into it.
Wow. So then transitioning from storage for a minute, have you kind of said, okay, no more Canada, we're putting that behind us, we're strictly down in the US, strictly doing storage, strictly doing development for residential? Or how does Canada tie into your business model today?
Yeah, no, that's a good question. So we're wrapping up a lot of new developments, all multifamily sites in Barrie, Ontario right now. We still have one in Collingwood that we're doing. And then what I'm ultimately going to do, to be honest, is I'm going to spend most of my growth for the next year in doing sewer and water work, which is it's a different asset class. So you think about, we've done hundreds of deals. Okay.
Yeah.
And we've all read the book Rich Dad Poor Dad, and it's you're going to get all this cash flow and you're going to be able to retire and blah, blah, blah. And it's you know what? I don't know how many thousands duplexes that you have to buy for $200 a month cash flow. I'm we've been always cash poor. Okay. The only way we ever got paid was either through a sale or a refinance.
That's right.
Right. Yeah. And it's just and then as we're investors, all we do is go and sink it into the next deal. And it's why do I do this? I'm going to focus on generating another income stream that's actually going to create, cash flow versus
cash business.
Cash business versus, just dumping it all into real estate. I think, taking it a little slow and just seeing what happens over the next 6 months is probably makes sense too, just being very cautious and being more calculated. What I will be doing, when we are doing more in Canada, it will be land development. We're realizing the profits just now, even in this time of trying to sell them. It's still really good, compared to doing duplexes and triplex conversions. Less sites. It also comes with their own struggles with financing, and capital requirements on these projects is significantly higher. But that's kind of where we're at.
How many people do you have back in the Ontario market doing the water sewer active business?
So it only takes us 4 people to really do it. And it's one of those things, we learned how to do that by servicing our own sewer and water,
right,
for our own properties. And then we start doing it for other investors that we know. And so
I remember seeing on Facebook one day, I was you're running a backhoe, or you're down in a trench or something. What is he doing? What is he up to today?
I mean, again, back to the basics. If you didn't know how to do it, just hire a coach. So we just hired a plumber. I mean, we have the excavators, we have skid steers, and it's not rocket science, but we just had never done it. We didn't really know the risks and what could go wrong. So we hired a plumber that does this all the time. And we paid him $90 an hour to sit there and guide us through the first one. After that, we're like, perfect. We've got this creative system, and just do it. Yeah. But so I think for people, it takes, usually two people that can operate equipment and a ground person, and a supervisor, right? Just to be on safety at all times. That's their only role is what we need. And then of course, like our office admin will be looking after the back end.
Yeah. What are the margins like in sewer work as opposed to doing something like development?
Well, let's say, for example, like the semi-detached ones that I did on RDOT, those were about $80,000 to $90,000 each is what I was quoted. So that's a lot, that's 160,000, call it, per set of semis. The other struggle was even just trying to find somebody to do it.
Sure.
So we obviously that was not our cost. But, and we're not that expensive when we're doing it. We're significantly cheaper than that. But it's still high profit margins. It's also high risk too. And not everybody can do it. So, I would say, you're probably looking at like a 60% profit margin though.
That's fantastic.
Yeah.
And you're getting paid.
It's a high use of time. Yeah. It's a high use of time. It's fast, right? Yeah. You're not tying up your capital or, these projects take three days to 2 weeks to complete, depending on how many there is.
Yeah. Do you need to be certain kind of bonded to cut into the road in the municipal infrastructure?
Yeah. So, our company is like our construction company is just have to have the proper amount of insurance.
Yep.
Yeah. It actually blows my mind that the city is just letting you do that, but they do. Wow. Yeah.
In my local area, there's only there's only like 5 companies that are legally allowed to cut into the municipal infrastructure like that. So unless you're one of these 5 companies, like you're stuck. You got to hire them.
Yeah, that's interesting. So if I was in that area, I would just get on that list, I guess.
I guess so.
Yeah.
All right. So jumping back into storage down in the US. So now we've decided on the site, we're financed, we're good to go. Shovel goes in the ground. Tell us a little bit about the construction process and how that works.
Yeah. So the construction process, so we hire a GC. Okay. So once we have a complete set of design drawings completed, then we'll obviously go into the building permit at that time once it's complete, but we'll also send them out to general contractors who build self-storage. Okay. So again, the nice thing about this type of project is, you don't have to be the GC like you would probably on a residential project. You don't have to be the expert. You just need to know the person that is the expert. So, so we send it out to general contractors. General contractors put bids on the entire project. Okay. So they're going to basically give you a quote and say, here's the number. On the first project that we've had the general contractors come back, we've already selected them. It's a company called Capco, but that's what they build self-storage. They build lots of other stuff, but it came back 2% under budget. Once you have that, there's obviously a bunch of contracts that have to be completed and signed and bounces back and forth to the lawyers and whatnot. And then that contract is all going to the bank as well, right? To make sure that the bank is satisfied with that. And then it's a 12 to 16 month construction period. On the first one that we're about to break ground on, like the Capco is very confident they'll be done in under 12 months.
Wow, that's quick, eh? Cool.
Yeah.
For hundreds of thousands of square feet.
Yeah. So it's 109,000 net rentable. So that's inside square footage, right? And that has one large 3-story climate controlled building, and then a whole bunch of drive ups, along the rest of the lot on the exterior.
So as a comparison, a year to build this many square feet versus in Canada, it takes about the same amount of time, arguably, maybe longer, maybe shorter, to build an infill home.
Yeah, well, the ones that we're selling right now, we started last November.
So that's a year. 12 months.
So it's and that's for 6 units.
Yep.
And right. So I think one of the biggest differences from doing this in Canada, well, we already talked about land values, right? But the other thing is just how long it takes to get approvals for it. One of my friends is actually building one on Mapleview in Barrie. And so COVID had something to do with, took part in this. Let's just say COVID took a year out of it because he wanted to sit back and make sure he was, in a good spot. But it's been 4 years. 4 years. So let's say take a year out of it. Let's say it's been 3 years.
Yeah.
Like, I'll have probably 30 of these built in 3 years. Right? Like it's just, you can't compare.
Wow. How do you feel that the margins are in construction on storage in the US versus residential? Like if you sold, let's just say if you sold $1 million building in Canada, right? Versus you build a multi-million-dollar building in the US. Where do the margins fall and how do they compare?
Yeah, you know what? That's a good question. I mean, I think we did very well on our residential stuff in Barrie that we're finishing right now. You know, part of that was due because we bought these now 2 years ago,
Mhm.
and we did a lot of the stuff. We did we severed them into multiple sites, so it's
Yeah.
almost like it's like all that value that you create. Most of the value you created was in that land. Well, to
Mm.
be honest, it was
Mhm.
actually about half of it. So I would say, um, if we profited, let's say we profited 800,000 on a site, because there was a bunch of duplexes
Yep.
or a bunch of triplexes. I would say half of that value was made in the development of the land and
Yep.
getting it so to a point where you could build three triplexes versus one, and then the other half was actually in the construction.
Interesting.
Right.
Interesting.
So, obviously these projects in the US are way larger. The equity profit, really depends on cap rates and where they land out in 3 years. But, it's anywhere from $7 to $10 million per site.
Wow. That's a way
Obviously
better use of time.
it's yeah, exactly. Just different challenges, right? Obviously the one that we did in Canada, that was all our money. This one is a whole bunch of other people's money. There's,
Mhm.
there's just different challenges, different problems to solve. But I think that the nice thing that I think about the strategy in the US is that it's really scalable, right? Like there is still lots of locations in the US, unlimited amount of locations where storage is really good. There's such an in-migration of people into certain areas, so you can expect that the demand for storage is increasing, not only just because of net immigration, but also because people are buying and keeping more stuff,
Sure,
right?
sure.
So, and yes, and they only take a year, right? I think, if you can do 10 new constructions in Canada, or 10 duplexes, once we get this figured out and systematically done and complete and create the right relationships
Mhm.
to the who, not the how, it's just as easy to scale as it is doing a bunch of duplexes, triplexes in Canada.
Awesome. So let's talk about the exit. So now that we're on the tail end, we talked about the dirt, we talked about how to build it. Now we're on the backside. What do we do with it when we're done? Do we refi? Do we keep it? Do we sell it? How do you see this?
Yeah, in a perfect world, you refi. But I mean, the some of the key metrics on determining whether you refi or not is going to be the exit interest rate. So, these are obviously commercial properties. So, cap rates is really what's going to determine. The cap rate and the interest rate are the two things that are going to really determine, what your exit is.
Right.
So obviously, when we started this on our very first project, the interest rates we were projecting was at 5% at the time of exit. So that was at the time of 3 years. So with that interest rate and the current cap rates that we were seeing, which was like 4.5, which we are still seeing today, we're just being super conservative.
Mhm.
Then the numbers work for takeout refinance that would get enough capital out of the refinance to return the investors capital back,
Yep.
plus give them their return on investment. Okay, they would still make their 20 to 30% IRR return on their money, and we'd still be able to hold it. Okay, but because the interest rates are obviously climbing, right? Which what does that do to your net operating income?
Yeah.
It's
Crushes.
going to drop it, and then your
Mhm.
cap rates. We don't know. We haven't seen them move, but you can only assume if interest rates go up, the cap rates are going to go up, which means
Right.
the value comes down, which means your takeout refinance is the takeout capital in your refinance is a lot lower, which
Mhm.
means there's a really high probability, or there's at least a risk of us not being able to return the capital to the investor. So what we decided on all of our deals going forward, the strategy that we present to the investor is that we are obviously going to buy this piece of land. We're going to build the facility. We're going to complete the lease up. We're going to stabilize it. And we're going to sell the asset as soon as possible between years 3 and 5, because
Gotcha.
that is one of the things that doesn't really matter where the cap rates go. Like the cap rates could be worst case scenario at 6.5% or 7%, and the investors are still going to make an amazing return on their money, right?
Mhm. Mhm.
So it's almost like, it's kind of foolproof from that perspective. But with it does still give us the ability to refinance if the market conditions are favorable. So let's say, for example, this deal that we said to our investors, we're going to sell it, and that's when you're going to return you see your profits and your return on your investment and return
Yep.
of capital. But if the interest rates are at a proper rate and the cap rates are that are favorable, well, then we'll do a refi, take out refi. We'll give the investor back all their capital, all their profit as projected, but they'll retain equity in the deal and we'll own it and we'll have cash flow for years to come. We'll hold it
That's
for
right.
5 to 10 years.
Yeah.
Right. But
yeah.
those were the kind of where we started was refi. And now what we're projecting is to sell it, just to, to make sure that we can, give them something.
Do you tailor your development at the beginning to a specific buyer on the back end?
Yeah. So, we've been working with actually a bunch of different companies right now. We're starting to create relationships with them because there's a lot of storage is such a hot asset class. Like it's a 40 some odd $billion asset class now. They expect it to go to 60 in the next, few years. And so, we're working with CubeSmart. So they're doing a property management company. They're doing third-party property management for us. But there's like all the REITs are buyers, the big REITs, the real estate investment trusts. And so I've actually got a list of like the top 100 in the US, and you can see who's buying and what classes of stuff they're buying. We're just reaching out to these companies and partnering with them, and and building your buyer, right? Why not work with your buyer throughout the way? And and try to get one of those knots half tied before you plan to exit it.
Get a knot half tied. I like that.
Yeah. That was actually right from one of these guys. That's like, I plan to half tie this knot for you, Brady. And so we'll build these things together, right? And I was having a conversation with them. This was just on Thursday, and he's like, I told him my goal is to build 10 of these a year. And he's like, okay. He's like, well, just let you know, like, we don't want to do anything unless we're scaling it. So my goal with you, Brady, would be get you to go from 10 to 20 a year. Right. And he's like, then I just need to find 5 more of you. And I would hit my goal doing 100 facilities a year. It's like, the amount of money down here in the US is just next level. It's just, and these type of people that, are saying the things that I'm telling you right now, they're everywhere. Right. And
Really?
you got to get out there and create relationships with them.
How do you, from the mindset side of things, how do you keep your head on straight with so much on the go?
Yeah, it's honestly been a struggle. I'm not going to say like, the market and what's going on. And sometimes I jump in, you get yourselves into stressful situations. And more recently, it's been a little bit more of a struggle because the more active you are, the more moves you're making, the less you really know. The higher risk position you put yourself in. Sure. But a big thing for me is fitness. I mean, I did the 75 hard back in 2019, 20, and that changed my life. And what it did is just really focus. Well, it teaches you how to do the uncomfortable, hard things, do the things that are inconvenient, do all the things that we're really supposed to do anyway, right? That'll only not only look after your body, your mindset, and your business. That's what it taught me to do. And my deals went from $100,000 equity deals to $1 million, and then doing the land development. And then I did start doing Ironmans, which is a triathlon. It's a 6-hour race. And it's like, you have to do these long days of training. I mean, every single day you have to do that. Like and you're doing stuff again consistently that you do not want to do. And what that teaches you, it teaches you to be resilient. It teaches you to be, to be able to endure, to sacrifice, to, all of the things that if you look at like all the attributes of an Ironman, those are the exact same attributes it takes to be an excellent person as an entrepreneur, or an excellent dad, or an excellent mom, right? The exact same things. So, so I've been adding a lot of things to my calendar. Actually, Jesse Itzler is going to be at Wealth Hacker this weekend, right? So. Yep. If you know Jesse, he's a big proponent on life experiences. And he's got this life resume calendar. So he's got this big ass calendar. It's literally a big calendar. It's called the big ass calendar. And just like plunking, things on that calendar to have an amazing life full of experiences. So, one of the things that I have is that calendar, and just like, I put a full Ironman on there. I'm doing a 50-mile run from Key Largo, or actually marathon, Florida, down to Key West. Yep. What else have I got on there? Marathons, just different stuff like that. But like these things are the things that you need to work on your mindset, right? Yeah. And so I'll leave you with this: is that everybody thinks that they need to read books to get a better mindset, or they need to go to different events, and that's going to help your mindset, and that's complete BS, right? Mindset's a muscle, right? And the muscle needs to be worked just like your biceps. right? So how do you work that mindset? Well, you have to put yourself in uncomfortable situations, right? And that's how you get really good at it, enduring and becoming excellent at anything, including being a parent. So I think that's the biggest thing, practice your mindset.
Wow. Brady, thank you so much for coming on. I mean, just to see the way that you're articulating all of the things that you're doing down in the US right now, it's truly inspiring. I mean, to see where you've come from. I know you used to be like a tree guy, or you're working for Hydro or something, and then you got into real estate, and now you're here doing massive developments. And, you know, something you mentioned of most importance that I took away from this podcast personally was endure. You have to be able to endure the uncomfortable situations, and you're clearly doing that. So thank you so much for coming on the show today. I really appreciate it.
Yeah, thanks a lot for having me, Ryan. I appreciate it too.
Where can people find out more about you?
I would say Instagram, Facebook. You know, you'll probably put the stuff in the comments or in the notes. But yeah, so you can hit me up on that, or of course we've got a website. You know, but any one of those. My email is brady@brightworkdev.com. I'll give that to you too. But
awesome.
Yeah.
All right. Sounds good. Thank you so much.
Okay. Awesome, pal. Thanks a lot. Have a great day.
All right, thanks again for listening to the Highest and Best Use podcast. Don't forget to sign up to the book at thehighestandbestuse.com. I'm your host, Ryan Carr, reminding you that good deals are found, great deals are created. Like, share, follow, and subscribe, and we will see you on the next episode.